when we're not taking investment risk with money we need to pay our bills, then we have a longer runway. So, we always say bad decisions are far worse than bad markets, and we know markets recover over time. So let's talk about performance in the last 75 years. The S&P was down about 33% of the year. So one out of every 3 years, the S&P 500 for our viewers, Aaron, is 500 stocks. That's why it's called the S&P 500, but it's the most widely held company. So this is a great barometer of the market. So essentially, 2 out of every 3 years in the S&P are up. 1 out of every 3 years is down. The average yearly increase, and I looked at 75 years of data for this, is 16%. The average yearly decrease is 12%. Now, that may not seem like a big difference. That's 4. I did that without a calculator. But at the end of the day, the bull markets last a lot longer. So those numbers compound. So that we're having longer strings of up markets. And then we have a clunker. Back in the 70s, there were a couple bad years in a row. We know 2000 to 2002.com, not particularly pleasant. But even when you go to the Great Recession, you look at the market being up 5.49% in 2007, 2008, down 38%, worst year since the Depression. And then the next year, it was up by about 26%. So, and then when we get into more recent vintage, we know COVID was what we call one of these V-shaped recoveries where it goes up and down. And then the bear market was, about a year. So it is the emotional decision-making that causes problems. But I will say this over and over and over. If you segment money properly, then you're not going to be susceptible to it, or at least less likely to make an emotional decision, because you know that the money you need to pay your bills, Aaron, that you're not taking risk with it. And so all these things are kind of tied together, but that's what I mean when I say avoid emotional decisions. You could say, oh, easy for you to say, but no, if you're not putting money at risk that you're going to need in the short term, you can do it.
Also, having a plan that accounts for all, long-term decisions and market volatility makes you less likely to have those knee-jerk reactions where you're reacting emotionally.
You know what? We're not spreadsheets, right? We're not algorithms.
We are not robots.
We are not robots. We're people. So yes, and by the way, the plan doesn't have to be complicated. I talk about this all the time. Can you go to full screen on me? I can show everybody the banner I have behind me. I always say that your journey, wrong way, your journey, it's not easy being me. Your journey to financial safety, simplicity, and strength begins today. And the simplicity part is that I think that if we look at creating income, and we look at reducing the volatility of our investments, and if we look at doing some proper decisions with either long-term care or Social Security, those kinds of things, it's not that it's this whole thing. It's really just a few things. So yeah, a plan helps people avoid emotion, and that's important.